Welcome to Daily Digests for August 12th, 2026. Semiconductor and specialized AI cloud stocks staged a powerful rally today, led by Nebius Group, surging 34% following a massive Q2 earnings beat. The move triggered a sharp short squeeze across neocloud providers, directly squeezing bearish options positions disclosed earlier this month by Burry. At the same time, Bank of America announced a $250 billion critical infrastructure financing commitment, signaling that bank-level capital continues to flood into digital infrastructure and GPU compute capacity. Looking closely at Nebius Group's Q2 earnings report, top-line revenue reached $582.3 million, representing a 454% year-over-year increase. More importantly for institutional investors, Nebius turned profitable on an operational basis, posting positive adjusted EBITDA of $236.2 million. Management confirmed 4 separate enterprise AI cloud deals signed during the quarter, each carrying a total contract value exceeding $1 billion, while raising their year-end power capacity target to 5 gigawatts. This strong fundamental performance triggered immediate price action across the specialized AI cloud sector. CoreWeave stock jumped over 19% in sympathy as trading volume in Nebius surged past 60 million shares, nearly triple its daily average. High-profile short bets against neocloud providers relied heavily on the thesis that GPU compute would quickly commoditize. Today's massive upside volume demonstrates that near-term demand for high-performance clusters continues to outpace short-seller expectations. A core argument used by short sellers was the assumption that enterprise GPUs face rapid hardware depreciation within 2 to 3 years. However, real-world operational data from major data center operators shows that modern enterprise accelerator clusters maintain an effective economic lifespan of up to 10 years. Secondary markets for previous generation chips remain active for inference workloads, allowing cloud providers to write off hardware over a much longer horizon than skeptics modeled. Capital support for the sector received another major boost today. Bank of America launched a $250 billion critical infrastructure finance initiative covering digital infrastructure, data centers, semiconductors, and power generation. Running through mid-2027, this initiative represents a structured commitment to provide lending, underwriting, and advisory services across the entire AI supply chain, ensuring that capital availability remains robust, even as monetary policy stays tight. The scale of customer commitments is evident in CoreWeave's latest disclosures, which show an unfulfilled contract backlog of $104 billion. This includes $25 billion in brand new customer commitments added over recent months. Enterprise clients and AI labs are locking in multi-year access to GPU clusters to secure compute availability, providing multi-year revenue visibility for specialized cloud operators. Beyond the technology sector, fundamental earnings across the broader market remain solid. S&P 500 Q2 earnings per share are tracking at a 30% year-over-year growth rate when excluding non-cash investment markups from private startup holdings. Despite concerns over high interest rates, real corporate cash flows continue to support current equity valuations across major index components. In an environment marked by elevated interest rates and persistent cost pressure, business model selection becomes critical. Companies with capital-light operating structures, such as S&P Global, which collects high-margin fee revenue from debt ratings and financial indices, or McDonald's with its franchise royalty streams, are delivering superior margin stability compared to capital-heavy industrial peers. Macroeconomic models from Federal Reserve researchers indicate that R-star, the structural neutral real interest rate, has climbed 50 to 75 basis points higher in recent months, setting the baseline rate between 1.47 and 1.78%. A higher neutral rate means borrowing costs will remain elevated even after Fed rate cuts begin, creating a persistent headwind for capital-heavy businesses that depend on cheap debt. Global asset allocators are responding to this macro regime by shifting capital away from low-yielding nominal debt and toward physical compute assets and energy infrastructure. Sovereign wealth funds and private credit managers are increasingly treating data centers and power interconnections as core infrastructure assets, capable of generating inflation-protected real returns. Looking at international equity valuations, the MSCI Emerging Markets Index currently trades at 9.9 times forward earnings, a historical discount compared to the S&P 500 trading at 20 times. While U.S. equities command a premium due to tech concentration and earnings growth, this wide valuation gap presents selective opportunities in global supply chain leaders supporting the AI ecosystem. As corporate debt issuance surges to fund data center buildouts, credit markets are beginning to differentiate between companies generating immediate operational cash flow and those relying on aggressive leverage. Investors must monitor debt service coverage ratios closely, as rising yields raise interest expense for heavily leveraged market participants. To recap, today's market action highlights two key themes for portfolio positioning. First, specialized neocloud providers backed by real earnings beats and long-term customer backlogs continue to squeeze bearish bets. Second, pairing growth exposure with high-margin, capital-light compounders offers resilient earnings protection in a higher-for-longer rate environment. Thank you for tuning in to Daily Digests, and we will update you as tomorrow's market signals break.